At the moment, the latest stats from REWA currently sitting at 330. Solid performer in a challenging market. Hi, Michaelkeil here. Today I'm with Ryan Bridie, my in-house economist, and Ryan's going to talk to us about bond yield curves. Ryan, thanks for your time. Tell us, what is a bond to start with?
Okay, thanks for having me, Mike. Okay, basically a bond is a financial instrument which is purchased and pays you an annuity or a return on the investment. The easiest way to probably explain a bond is just to use a hypothetical example, and let's say a 5-year government bond you purchased for $1,000 and they're going to give you an annuity each year of $20. So that means the yield on your bond is 20 divided by 1,000, which is 2%.
Beautiful, excellent. And there's some sort of equation to tell us about?
Okay, the Fisher equation is a really good economic equation. It's obviously a lot more complex, but we can have a simplified equation, and all it really means is as inflation goes up, interest rates go up. Inflation goes down, interest rates go down. And so it's obviously inflation is a sign of increased economic activity. We can see that there's two ways that it will cause interest rates to rise. The first way is if inflation goes above what the target area is for the RBA will be forced to raise interest rates, and vice versa. Also in America, we can see at the moment that because their inflation has been rising, their interest rates are rising. Now Australia, we have a very small population, especially because of the size of some of our infrastructure projects. So what we need to do is we have to borrow a lot of money from overseas. So if the cost of borrowing money from overseas goes up, that's going to be passed on to the consumer here.
Yeah, I was going to ask you that because obviously the RBA is on hold, and they have been for a long time. And some of the small banks are increasing interest rates, and that's obviously the reason why?
That's correct.
Okay, beautiful. And tell us a little bit about the different types of bond yield curves.
Okay, well, before we get to that, the reason that yields differentiate from different types of bonds. If there is an increased demand for, say, a 5-year bond, that increased demand is going to push the price of the bond up. Okay. And as we've just spoken about, if the price of the bond goes up, the yield goes down.
Got it.
So that's why, depending upon the demand for the bond, will reflect the yield.
Yep, beautiful. Okay, and the bond yield curves, where are we at with that?
We have a look. There's sort of 4 very basic, but the 2 we're really just going to really focus on here is your standard yield curve. We obviously got yield on the vertical axis, the date to maturity on the horizontal axis. It slopes upwards because there's a risk, a time associated risk. And so if you're going to invest for longer, you're going to want to have a yield that's greater. So that's why it's sloped like this. This one, however, is an inverted yield curve, and this is a sign of a recession. Every recession America has had since World War II, this has preceded it. So this is, it's a fact that right. This is how it works.
Okay, now with the yield curve, I believe we're here.
That's correct.
So no recession
Definitely not.
inside at this stage. So,
no.
So that's a really good summary. Obviously, the US markets where we borrow from, cost of money is going up for the short-term rates. So therefore, the banks are having to pass that on. So if you're an investor looking to buy into the market, or a first-time buyer, it's quite likely that rates are probably going to go a little bit higher in the short term by the banks, but not the RBA make any changes.
That's correct, and we can see by the graph here, the important part for us to really look at is we can see the 6-month is the black dotted line 6 months ago, the blue line's our current. So we have flattened a little bit, but what the important part is this is shown in here, and what it's saying to us is the yields have gone up, which means the price has gone down. And the price has gone down because people are selling more of their bonds. So they believe that interest rates are going to increase. I'm going to sell my short-term bond so I can put the money into another kind of investment which will deliver a better rate of return. So this is saying to us that interest rates will rise. The interest rate rise won't be coming from the RBA, it will be coming from the cost internationally, and this also then leads to the situation which may force the RBA to lower rates here because of our high levels of household debt.
Rightio. Wow, that's a very good summary, Ryan. I really appreciate your time in explaining the bond yield curves, and that really explains why some of the smaller banks are increasing their interest rates to their customers. I don't think the big banks have moved yet, have they?
No, not yet.
Okay, that'll be interesting to see.
They've already hit me up.
Fair enough. Well, look, I hope you've enjoyed today. If you're interested in getting more information from our in-house economist, email Michael@Michaelkeil.com. We'll put you on our weekly newsletter. Ryan does the articles. It's always great information on where the market is heading, whether it be interest rates, unemployment, prices. So send me an email. Thank you again, and bye for now.